Be an expert with our how-to videos for real estate. Here's your host, Mike Leese, with tips on the loan process.
Hi, I'm Mike Leese, a realtor with Your Castle Real Estate and head of Your Colorado sales team. Welcome to the lending section of our how-to video series. Of all of our video series, this is one of the most important subjects to learn. The biggest reason a contract doesn't close and buyers don't end up buying a house is due to issues with their loan, which is why finding a great lender will make all the difference for a smooth, stress-free transaction. We're going to start off this series with the most asked loan questions answered by Joe Massey with Castle & Cook Mortgage, and then Joe will explain all the typical loan types in the individual videos below. Joe hosts multiple classes where he's taught countless agents and buyers the ins and outs of the loan options. I highly recommend watching the entire series before talking to any potential lender, and when you have loan questions, give Joe a call. You'll see why he's our preferred loan officer. I'd also like to thank Joe for putting this information together and spending the time to share it with us on these videos. Even if you're an investor, don't skip to the investor loan section below without going through this first part. Everyone can learn something new from this loan overview series. So without further ado, here's my friend and loan guru, Joe Massey, to answer our top asked loan questions.
Hi, I'm Joe Massey with Castle & Cook Mortgage. I'm a senior loan officer and I've been working in residential financing for about 10 years now. I'm the in-house lender with Your Castle Real Estate, do a lot of work with Lon Welsh and Charles Roberts and all the agents here at Your Castle. We work on primary residence, investment properties, second homes, just about any type of transaction you can think of for residential properties. What are the differences between being pre-qualified and being pre-approved? So part of the loan process when a client's ready to buy a new home is they'll get in touch with me and we'll take them through a basic application. I ask them some very personal questions like their date of birth, their social security number, information about their income, their job history, things like that. And based on that verbal information that they provide me, I can give them a pre-qualification letter. That pre-qualification letter is going to say, based on your credit report and all this information, it appears that you will qualify for a new loan. Pre-approval is the next step, in which point I will ask for documentation to support the verbal information. So I'm going to ask for pay stubs, tax returns, bank statements, driver's license, verification of your credit report. And then at that point, we can upgrade you from being pre-qualified to being pre-approved. Pre-approved is has a little more weight to it because it means you've actually provided documents and we can see that we can actually get you approved for that mortgage. What documents should a buyer have ready when they want to apply for a new mortgage? So right here on the back of my business card, I actually keep a list of all the documents that you're going to need. It's really straightforward, but you do want to start gathering these items as soon as you're ready to apply for the loan. Number one is we need your 2 most recent pay stubs. We need your 2 years most recent tax returns and W-2s. We need your 2 most recent bank statements, all pages of the statements. This is a big one. If it says page 1 of 6, don't just give us the first page. We need all 6 pages. We'll need your most recent 401k, IRA, or retirement and savings accounts if you're going to be taking funds out of those for your down payment. We need the name and phone number of your homeowner's insurance agent. We of course need the contact information for your real estate agent. If you're receiving any type of fixed income like Social Security or pension, we'll need those awards letters and verification of that. We'll of course need a copy of your sales contract and the earnest money check. And then there's a few other items that may apply. Sometimes if you've been recently divorced, we might need your divorce decree, or if you recently had a bankruptcy, short sale or foreclosure, we may need some information about that transaction, but that's really going to be on more of a case-by-case basis. The first items I listed off are going to be your most critical items, and then the last one is a very important copy of your driver's license or social security card to verify your identification. How do mortgage companies determine the amount that you can qualify for? Once you go through your application with me, I'm going to ask you a lot of questions about your down payment, your income, your credit. We're going to look at all of those in a combination to see how much money can you afford to invest in the home. Generally, the minimum down payment is 3.5%. So do you have that down payment saved up? We're going to look at your overall income and expenses. How much money do you have going out every month versus how much is coming in every month. We want to see that you can afford all of your current debts and your living expenses and afford the payment on the new house. So the last step is, of course, we'll review your credit. We want to make sure that your credit is sufficient and you've got a good history of paying all of your debts on time. Then we look at all three of those items in conjunction with the new home that you want to buy to make sure you can afford the payment, you've got sufficient down payment, and you have a good credit history. What percentage of a purchase price does a buyer need for a down payment? The minimum down payment for an FHA loan, which is very common for first-time and repeat homeowners, is 3.5%. The number I always tell folks to keep in the back of your mind is on a $200,000 home, you'll need to have $7,000 for your down payment. If you're buying a smaller home, you need less. If you're buying a larger home, you'll need more. If you're looking at doing a conventional loan, you'll need to have a minimum of 5% down. There are also some down payment assistance programs. Depending on your income and your qualifications, you may be able to qualify to purchase a home with as little as $1,000 down. Really, it's going to vary on the loan type, the property type, and your individual qualifications. It's a big part of what we do when we're meeting with our clients is go through and figure out how much you want to invest in the property and will that meet your goals for the type of loan you're trying to get. So a big question that I get is, if you've had a bankruptcy, foreclosure, or short sale in your past, can you still get a mortgage? The answer to that is maybe. It's going to depend on how long it's been since your bankruptcy, how long it's been since the foreclosure, and how long it's been since the short sale. Also, what's been going on with your credit since that time? Have you made improvements to your credit, that you've established new trade lines and you're making positive steps in your credit? Have you saved up a good down payment? Have you had any major job changes since that event? What led to the event? Was it something outside of your control, or was it financial mismanagement? So there's a lot of questions if you have had a bankruptcy, foreclosure, or short sale. We're going to have some questions for you. Does not automatically disqualify you, but there may be some specific waiting periods before you can be approved for the new mortgage. What minimum credit score is needed to qualify for a new mortgage? So the minimum credit score that we want to see is a 620. We're going to take the middle of your three credit scores. So if I pull your credit report and you've got a 647, a 621, and a 619, we're going to go off that 621 middle score, and you're going to potentially qualify for the new mortgage. Now, of course, we are going to look at, again, your income and your assets to make sure that everything else looks good. But as long as you have above a 620 credit score and you don't have any major lates or collections, very good odds that we can get you approved for a mortgage. How long does the typical closing process take? From the time you go under contract, there's going to be a lot of steps while you're getting your inspection, your appraisal, loan approval. Generally, you want to factor about 30 to 35 days for your full contract time. Can be a little bit faster if you're really on top of your game and get all of your documents in to me right away. Also can take a little bit longer if you're getting a special niche program like a USDA loan or sometimes a VA loan can take a little bit longer. But for the average homeowner or average purchaser, I'd say about 30 days is more than enough time to close on your loan. So a question I often get is, are interest rates going to go up or down? And unfortunately, it's very tough to know what's going to happen with interest rates. What I tell everybody is, if you're happy with the rate that it is today, I recommend that you lock it in, because if rates go up tomorrow, you're going to be really unhappy. An important thing to keep in mind is an increase in interest rate of 0.25% can potentially impact your buying power by as much as $10,000. Now, that can vary a little bit depending on your down payment, the type of loan you're getting, but for the average homeowner, if you're qualified for a $200,000 loan at a rate of, say, 4%, and rates go to 4.25%, your qualifications may now only be up to a $190,000 loan. So you really need to watch out. If you're buying right at the top of your budget, I would definitely recommend locking in your interest rate and making sure you know what it's going to be all the way through to the closing. After you've locked in your interest rate, if rates happen to go down, can you relock at a lower rate? Generally, the answer to this is no. A rate lock is exactly that. You have locked in your interest rate, and it's not going to go up, but it's not going to go down either. There are some special circumstances that if interest rates decrease by 0.75% or more, you may be able to renegotiate with your lender, but that's going to be very specific on a case-by-case basis. What you want to keep in mind is if you're locking in your interest rate, you're doing exactly that. It is locked, that's it. So I always encourage you, if you're happy, lock it in, rest easy through the closing. I frequently get asked about jumbo loans, people buying larger homes in the $500, $600, $700 million range. Jumbo loans are going to be anything greater than $417,000 for a single-family residence. $417,000 is the maximum amount in the Denver metro area for a conventional loan backed by Fannie Mae and Freddie Mac, which I'm sure you've heard of. Anything above that is going to be considered a jumbo loan. It's going to have a little bit higher interest rate, potentially some more difficult qualifying, and you might need a larger down payment. Generally on a jumbo loan, you may need 20 to 25% down. Again, these are going to be very specific to the individual buyer, the individual property. If you're looking in that price range, I really encourage you to get in touch with me so we can walk through the specifics of what it's going to take for you to qualify for that loan and be approved. What are my top 3 loan programs? The most frequent loans I do are FHA loans, conventional loans, and VA loans. FHA are generally going to be purchase or refinance loans with a minimum of 3.5% down. We mentioned that earlier. On a $200,000 home, you'll need to have at least $7,000 to invest. Conventional loans are going to be a minimum of 5% down, sometimes as much as 20 or 25% down payment. Again, on a $200,000 home, you're going to have a minimum of $10,000 down payment. The last loan program that we do a lot of is VA, stands for Veterans Administration. This is a great loan program for honorably discharged veterans and active service members. This actually allows the veteran or service member to purchase a home with no money down. Really a great program for our service members working out of Buckley, veterans here in the metro area. Those are my 3 best programs that we utilize, I'd say probably 95% of the time. How can a buyer finance their closing costs? On most loans, you're going to have to make your down payment for, again, for example, on FHA, 3.5% down payment. And then, of course, you're going to have some closing costs that are going to consist of your processing fees, your title insurance, taxes, homeowner's insurance, and other costs associated with getting the property. Generally, you cannot finance those into the loan unless you're doing a refinance. So on a refinance transaction, we'll pay those as a part of the loan proceeds. But on a purchase, the loan is going to help you buy the home, so those sales proceeds are actually going to the seller. So what we'll do a lot of times is negotiate with the seller for the seller to pay your closing costs. When you're writing up your offer, of course, you'll have your pre-approval letter that you've gotten from me, and you'll want to give that to your real estate agent. Your real estate agent should then be getting in touch with me, and we'll talk about the closing costs required for your specific transaction. Then you can negotiate in the contract for the seller to pay those items. So again, you're just coming to the table with your minimum 3.5% down payment.
All right, that's all the time we have for this video, so join us in the next video for part 2 of the most asked loan questions with Joe Massey.